So let me take this opportunity by welcoming you to August, December, it should be September, December semester 2023. I just want to look on the content before I do my introductory topic today. So in that case, I just want us to have or be prepared. You're supposed to be having the calculators. You're supposed also to be having some areas where you are supposed to be writing. No unmuting unless I request you to do so. So the first topic that I will be able to, the first topic of the financial management, which normally includes some computations, it is normally called the time value for money. The time value for money. Number two, or the second topic that we are supposed to be checking here, number two, we are discussing about financial assets. Financial assets valuation model. Financial assets valuation model. Number three, we normally discuss about the introduction of the capital structure. Introduction of the capital structure decisions. Why are we talking about being an introductory topic? Is because when you go to the advanced level, you will be able to find that we're going to be discussing about, this will be our first topic under the advanced level. It's normally called the advanced capital structure decisions, right? Then we have the introduction to capital budgeting decisions. Number four, introduction to capital budgeting. Introduction to capital budgeting decisions. Then we normally have financial statement analysis. Number five, financial statements and analysis. Financial statement analysis, and forecasting. Financial statements analysis and forecasting. Then we have another topic here, which we normally call it working capital. It's normally called working capital management. Working capital management. Then number seven, we shall be able to look for a topic called dividend decisions. Dividend decisions. Then we have number eight. It is normally called the introduction of portfolio analysis. Introduction to portfolio, we are calling it introductory part, because when you go to the advanced level, you'll be able to find a topic of its own called portfolio analysis. Then there is theoretical topics now, which I normally share theory topics, which I normally share with you. One of the topic I can call it Islamic finance, right? Number two, all the topics that you're supposed to be knowing, it is normally called financial institutions and markets. Financial institutions and markets. Financial institutions and markets. Number three, we normally have something called the financial decisions. The financial decisions. Number four, we have the overview of financial management. What is the overview of the financial management? Then the last topic that you're supposed to be knowing regarding to this. We normally have the personal financial management. Personal financial management, right? Then number 6. The 6th topic here should be the contemporary issues and emerging trends. Those are the topics which the examiner requires you to have an overview. So, where are we going to be starting our semester? I just want to, we're not going to be following the content the way it is, but where it is the requirement, I think we are supposed to be doing so, because now the time value of money normally follows the financial assets. Then we normally come up with the capital structure decisions and the capital, we normally introduce the capital budgeting decisions. And then later on, we come to the introduction to the capital structure decisions. But the other three, the 3 topics, they don't need you to follow any sequence. And today, I just want to start by looking on the working capital management. Working capital management is a topic which I just want to do right now. It's a topic I just want to do right now. So I just want to share my notes with you so that we can be in a position to look on what does this working capital management entails. I know that you are having all these notes, and if you don't have, I will just be able to share them once again. So there is no any problem in regards to that. So let me just share my notes with you so that we can move quickly. And when I look on the working capital management, these terms might not be new to us. They might be familiar. When we are discussing about the working capital management, we are saying it refers the management of the current assets and the current liabilities. And when we discuss about the current assets, right? When you discuss about the current assets, it means that you just need to be having an overview of the breakdown of the statement of the financial position. We know very well that we normally have non-current assets, and then we normally have current assets, and then we have to be looking on the current liabilities together with non-current liabilities. And those are the things that I know very well that you will be in a position to cover up when you will be doing financial reporting. I don't teach much regarding to that. But when you're looking on the current asset, it means these are the things, or these are the items, for instance, which can be easily converted. You can just be able to convert them into cash. And basically, we are discussing about debtors. We are discussing things like we have debtors, we have things like cash, we have inventory, among many items which normally qualify for the current assets. So that is why we are saying that the gross working capital refers to the total assets, while the net working capital is the difference between the current assets and the current liabilities. We normally call it the capital to the organization. In other cases, for instance, we'll be able to discuss about things like finance by and so on and so forth. Now, we are saying that the working capital management should be taken seriously, since the investment in current assets constitutes a significant portion of the firm's total investment. And we shall be able to learn much when we are going to be discussing about the ratio regards to the current assets and the current liabilities, where we are going to be discussing about the quick ratio. It is just a type of a ratio whereby we normally look on the how can our current assets that we have can easily be converted or can be able to cover up our current liabilities. Those are the things that we're supposed to be checking on there. But when we're looking on that aspect of the ratios, we normally say that things like inventory, we don't factor it as a first item which can be able to be converted into cash. We shall be able to learn much about it. And that is why we are saying, furthermore, the management spends a great deal of time when dealing with the matters related to the working capital. And this normally involves, one, negotiating for favorable terms of trade. Currently, due to the current economic situation in our country, you will be able to see business trying to renegotiate based on the selling price of the commodities, because it might be the production cost might be so high, and therefore making an organization struggle in terms of meeting the operational costs. Number two, we are discussing about monitoring the management of stock to ensure smooth flow of activities. And basically, we should be able to reach in a point whereby for those who are not doing management accounting, they will be able to see a topic later on today as a topic discussing about the inventory management. And when we discuss about the matters of the inventory, it means we just want to look on how the organization can be able to maintain, or basically the main objective of inventory management is just to minimize the liquidity risk and maximize the investments. And in that case is where we normally discuss about key aspects. We are going to be checking on, can you be able to maximize the profit? That is basically the key important things within the organization. And when you are maximizing when you are maximizing the profit, it means we also be coming up with policies which will be assisting the organization to minimize the cost. And that those are the things that I will be able to elaborate to you as much as I can. Now, determining the credit terms to be offered to the customers, and these are the things that we can be able to, or you can attest that you have checked them within the workplace, whereby you can be able to determine how do you normally review before you administer any credit to any customer who require you to sell the goods on credit. One, we have to be looking on the credit history of the data, for instance. And it is very important for you to be in a position to understand how the customers are. And we normally look on that. That information can be able to be provided by the Bureau. Now, we have the last one, the monitoring the cash movements to ensure that no liquidity problems exist. And in this case, it is very important to be able to master how do the cash movements within the organization. It is very critical, and to ensure that we are not going to be coming up with the issues regarding to, we are not going to be having any constraints in regard to cash flows within the organization. That is why we normally have the cash or the working capital management. What are some of the objectives of the working capital? And we are saying this is the aim at achieving two main objectives that always conflict with each other. And that is why I was saying, number one is to maximize the profitability returns of the firm. Number two, we have to minimize the liquidity risk. And that is where you normally find, for these, for instance, the insurance company to win you, they normally tell you, the higher the risk, you have to be taking any risk if you need any return. So in that aspect, it means I have to be a risk taker so that I can be able to, or I can be in a position to get a higher return. But the risk has to be measured. And that is why here we are saying, these are the risks associated with the lack of the cash in the company. You may just imagine how the organization might be, suffer if it does not have these kinds of cash flows. And you can see you might be missing the materials required for production, for instance. You might be not be in a position to provide the relevant services, among other challenges in which you might be facing if you lack cash flows. And that is why we are saying the main concern is to determine the extent to which the firm's assets shall be financed by both the short-term as well as the long-term funds. Now, I just want to look on the permanent. And when you look on the permanent fluctuations, those are normally called the variables, the variable working capital. Basically, we are also calling them the current assets. And we are saying there is always a minimum level of stock that will always be maintained by a given company so as to satisfy the normal demand. When we go to the management accounting, we are going to be discussing about the minimum stock levels, buffer stocks, among other kinds of stocks. And in this case, we are saying this table of current assets is fixed. The firm's non-current assets It is normally known as the permanent working capital. Over and above the permanent working capital, right, we are saying that the current assets will not fluctuate. E.g., we are saying that extra inventory may be required during the peak season stock periods. This extra working capital is known as the fluctuating seasons or seasonal working capital. When you look on the aspects of inventory management, and you'll bear me witness that within the organization, it is very important to state some key elements during the inventory management. One, we have to be looking on the concept where we have to be discussing about the maximum stock level. How much do the organization have to maintain? What kind of stock can an organization maintain to ensure that there is no any wastage within the organization? That is one of the key things that we have to be determining. The organization has to come up with a term, they have to be stating the lead time, the period between ordering and delivering of the orders with your suppliers. We have to be saying that we can have a lead time of 2 days, right? The period that we have to be waiting for the goods to be delivered is normally called lead time. Those are the things that we have to be stating. Then we have the minimum stock levels. The levels once reached, an organization has to place an order with the supplier. So I think the organization should be taking on to ensure that we are not running on stock. And because once we run out of stock, it means the organization might be suffering. The organization might be suffering in that aspect. Now, we are saying that over and above the permanent working capital, the current asset will now fluctuate. E.g., the extra inventory may be required during the peak seasons. I think that one I was able to check on. In financing firms' assets, we are saying that the management can adopt any of the foreign policies, stock strategy, depending on their risk attitude. And number one, we are discussing about the aggressive policies, right? The aggressive policy, we shall see how the aggressive policies normally look like. We normally have the hedging strategy. We are calling it matching stock, the moderate strategies. Then the last one, we are discussing about the conservative policy strategy. And in this case, I just want to be looking on what are these aggressive strategy, what does it entails? And we are saying under this policy, right, the firm is so much aggressive that it finances, it should not be its. It is financing the better part of the assets using the short-term funds. Now, we are saying that the short-term funds will finance fluctuating current assets and a portion of the permanent current assets. But sometimes you might be asking a very simple question. What is the short-term funds? And where can an organization get the short-term funds? Right? So what are these short-term funds? And we are saying very simple, the short-term funds refer to the money that has been borrowed for a short time, right? Usually less than 5 years. And we are saying that the borrowers are often businessmen seeking to raise short-term funds to clinch deals. That is why we are discussing the short-term funds is that an organization can be in a position to borrow, to inquire, and that is where we are going to be discussing different things here. And you have to be bearing me witness that these topics, these units might be sometimes giving you some headache, because when it comes to the Income Tax Act, right, it says that you can only be able to get income. The only income or the capital you can be able to get is by issuing the ordinary shares to the public for subscription. I'm requesting for someone who is opening his video to switch off, please. So when it comes to the aspect of financial management, the financial management tells us that we have different models, right, in which the organization can be able to acquire funds. One, we can be able to issue the shares, with the ordinary shares to the public for subscription. These are the people who we normally call them the owners of the business. The organization can be able to issue the preference shareholders, and this is where you normally seek some partners who want to benefit due to the growth of the organization by getting back the dividends, right? The difference between the ordinary and the preference is because when the organization, for instance, is making profits, there might be some policies made by the organization, which will not be able to require the ordinary shareholders to get anything based on the requirements and also the experience that we're going to be getting in during our time tackling all these topics. We shall be able to know why. But when it comes to the ordinary share, the preference shareholders, these are the people, when the organization reports any profits, they have to be considered first, right? That is why you normally see that an organization issues preference shareholdings or preference shareholders or preference shareholding to the preference dividends, sorry, to the shareholders. Now, the short-term funds will finance fluctuating current assets and a portion of the permanent current assets. We are seeing an extremely aggressive firm may even finance part of the non-current assets using the short-term funds, that the long-term funds only financing the remaining portions. This, with this policy, both the profitability and liquidity risk will be very high. So how does this normally looks like? Let me just show you in a graph. This is how it normally looks like. If plotted in a graph, how does it look like? So the aggressive strategy normally looks like this, right? Normally looks like this. We are discussing about aggressive strategy. So how does it normally looks in a graph? It normally looks like this. I'm not good in drawing. So under the y-axis, we normally place our assets, and here we normally place our time, right? So in this case, we are doing the comparison between the permanent working capital. It's normally the permanent current assets. It normally runs from the y-axis, not from the origin, right? This is your permanent current. We call it permanent current assets. Correct. Then we have the fluctuating current assets. Is somewhere here, right? They are normally called fluctuating current assets. They're normally called fluctuating current assets, right? Then it runs from here now, right? The financing might be looking like this. So in this case, we are saying in simple terms here that the short-term financing can be used to finance part and parcel, right? Can be used to finance the fluctuating current assets and a portion of the permanent. So it means these ones can be financed parts, the same parts. It can use the short-term funds. We can be able to use our short-term funds to finance our fluctuating current assets together with part of the permanent current assets. But the other part, we are saying that from here now, we can be able to financing using what? Because here we have non-current assets, sorry. Non-current assets. This one can be financing using the long-term financing. The long-term financing. We can be able to use the long-term financing when we want to finance our assets within the organization. So in aggressive strategy, in a graph, it normally looks like that. With the policy, that is why we say with the policy, both the profitability and the liquidity risk will be very high. It will be very high, right? So I think my board is visible. Now we said in financing firms, asset the management, the firm's assets, the management can adopt any of the following policies. And we said number one, we have the aggressive policy, which you can be able to use to finance our assets within the organization. Then we have the matching strategy, right? Here we have another one called matching strategy. The matching strategy, right? So what does the matching strategy entails? This is what it normally talks about. Let me show you, right? Let me show you here. And we are saying very well, under this policy, the source of financing is matched or related to the asset. The short term of finance, right? The short term of finance, the short term assets stroke fluctuate. Sorry, let me come again. Under this policy, the source of financing is matched, stroke related to the asset. That is, short term of finance, the short term finance, right? the short-term assets, which we are calling them the fluctuating current assets, while the long-term will finance the long-term assets. So in this case, it means that if we want to be looking on this policy, it means that the short-term financing will be financing only the fluctuating current assets, whereas the permanent current assets and non-current assets will be financed by the long-term financing. Now, in that case, we are saying that when this policy, we are saying a 30-day bank overdraft may be used to finance inventory to be sold in 30 days, while a 10-year loan may be used to finance a project with an economic life of 10 years. You can see that we can be able to use the fluctuating current assets, right, which we are saying that they can be financed within the short-term funds. And you can see we can be able to obtain, we are saying that at that day overdraft, you can take a bank overdraft, use it to finance the fluctuatings, but we can just be able to use a long-term loan of 10 years to be able to finance your permanent current assets together with non-current assets. How does this look like? And that is where we are saying, when this policy is used, both profitability and liquidity risk are more great, right? Are more great. So how does it look on a graph? This is what it means in simple terms. This is how this is how it normally looks like, right? It normally looks like this. So here we have our assets, right? Here we are talking about our time, correct? So here we have said we have our permanent current assets. We have our permanent current assets, correct? Then we have our fluctuating, right? Starting from there, it's normally called the fluctuating current assets. Then your fluctuating start from here. It looks like this. So we are saying very well, here we have our non-current assets, right? So we are saying that our fluctuating from here to here, we can finance using the short-term financing. Short-term financing. Then from here now, all the way, we can be able to use the long-term. We can be able to use our long-term financing. We can be able to use our long-term financing. That is how it normally looks like. The fluctuating current assets, and I've given you a good example there. We can use the short-term, a bank overdraft, but we can take a long-term for 10-year loan to be able to finance your permanent current assets and non-current assets. The third one, right, we have conservative. The third one, we have conservative, correct? So the third one, we are discussing about the conservative policy, and we are saying under this policy, the management is always at risk, is always risk averse, so that they make use of long-term funds in financing most of the assets, and the long-term funds will finance the non-current assets, permanent current assets, and a portion of fluctuating current assets. The short-term will only finance the remaining portion of the fluctuating current assets. Now, in this regard, we are saying both the profitability and liquidity risk are low under this policy. Why? Because remember, you are financing the conservative. Basically, we are saying we can just be able to use the long-term financing, by financing part and parcel of the fluctuating current assets, the permanent current assets, and non-current assets, where the short-term can be used to finance parts of the fluctuating current assets. How does it look on a graph so that we can move very quickly? This is how it normally looks like on a graph. If the examiner might be asking you, right, conservative strategy, right? So it looks like this. Here we have our time. Here we have our assets. So we start by looking on the permanent current assets. We have our non-current assets, right? Then we have our fluctuating current assets. So it normally fluctuates like this. So we are saying the short-term financing can be used to finance part of the fluctuating, this short-term financing. Then all the way from these points, we can use the long-term financing. We can use the long-term financing. That is all that it means. That is what all that information means. Now, I just want to look on something called the risk-return trade-off. Let us go to our notes. Kama naenda mbio, you just let me know. Are we drawing? Let me start by looking on Abraham Ayum. Good evening. Good evening.
Hello, can you hear me?
Yes, I can hear you, Abraham. How are you?
I'm all right, thank you.
Am I too fast?
No, it's fine. I'm okay with the speed.
Okay. Let me see on someone else. How is Dennis there?
Dennis is okay, following the class keenly.
Thank you. I think my board is visible. You can be able to see it.
Yeah, it's very clear. It's okay.
Okay. Thank you. There is someone called Paul. I can see he's just telling me not in the group. I don't know whether Paul is here. Good evening, Paul. Paul is not here. Hi, Mary. Good evening, Mary. One of the problems of the online classes is that you can put Mwalimu there, make noise, and then you go and start cooking. That will be very dangerous. Now, I think we are together with Sheila. Sheila is here. I hope she is following up the class. Hi, Sheila.
Hey, following.
Oh, good. So let us move on. I just want to look on the risk-return trade-off. What does this mean? And we are saying this is always a conflict between a short-term and long-term financing. That is, short-term funds are less expensive and higher risk, while long-term funds are very expensive and less risky. Can someone tell me whether this statement is correct? Right? You can see an organization can go and take a 30 million loan, right? In long term, you can see we are going to be paid for more than 30 years, for example. So you can see it is, for example, it will be very expensive because of the interest rates which you are paying, but also because you can see what is happening with Kenya right now. We are able to pay for the things that we have never done due to for example, for the money that we borrowed for a long time due to the different exchange rates. And if, for example, this money is being denominated by a different currency, you can see that eventually we are going just to be suffering as a country, which will be something of, it is something that we are feeling the pinch about what normally happens if such conditions apply. Now, I'm requesting someone to switch off. Let me see whether it is Paul. Right here, this Paul now. Let me stop the video. Okay. Now, we are saying the main objective, right? The main objective is therefore to determine the extent to which the farm shall be financed by both the short-term and long-term funds, so as to create a balance, so trade-off between the risk, return, and profits. Now, let us look on a simple illustration of all this information we have been discussing up there. We have different types of funds. We have the short-term funds. We have the long-term funds. What comes to the profitability? The short-term funds have high profitability, right? And they are very cheap, but they have high risk. And I will be able to see for the people who are investing with money market funds, right? WorldCoin. We used to have WorldCoin. I know how the people they took a high risk to screen their eyes. Now they are facing the consequences. Now we have the long-term funds. Based on the profitability, it is low due to the expansion, but it is of low risk. It is of low risk. It is of low risk. Now, I just want to do an illustration before I look on the factor that influence the firm's investment in the working capital. Allow me just to do an illustration there regarding to risk return trade-off. This question was tested, and I have already shared with you the link in our WhatsApp group. So just make sure that you use it. Make sure you are using the link, please. And I hope you are able to see my question. Want us to interact from, you can be able to be discussing, by the way, in our WhatsApp group. I have not been able to understand the following, right? Can someone explain to me what is happening? That is the best thing. I dislike failure. So it is very important for us to focus on passing, all of us. There is a paper here which was tested the other day, right? Just the other day. We have been told here, and you can see very well what I'm trying just to tell you. These are the things which are already tested. So the examiner is asking you to distinguish between the temporary working capital and a permanent working capital. Those are the things that we have already discussed in our notes, because we said that the permanent is always a minimum level of stock that will always be maintained by a given company so to satisfy the normal demands. And we are going also to be looking on the fluctuating, right, which it is called the seasonal. So that those are the things that you have in your notes. I'm just concerned with the requirement part 2. Someone can read for us. I will start with the Abraham, please.
Yes, I'm here. The requirement part 2.
Yes.
Okay. The monthly working capital required for Umbuni Ltd are given as follow. Month total working capital requirements. There we have sheet. So we have January 3,000, February 2,500, March 2,000, April 1,500, May 1,500, June 1,700, July 1,800, August 2,800, September 3,200, October 3,500, November 3,600, December 3,800. The short-term cost of financing working capital is 15% per annum, whereas the long-term financing cost is 20% per annum. The firm adopts an aggressive policy in financing its working capital needs. 80% of the firm's permanent working capital are financed using short-term funds, and the balance is financed using long-term funds. Required determine the total cost of financing the working capital needs of the firm.
Thank you so much. I know very well that some of us might already come across this question in just the concluded sitting. And it is very important to understand how can someone be in a position to tackle this kind of problem. And you will be able to find that this is not a hard thing. Just copy fast this information, like how I'm going to be doing mine here. So I hope you have opened the question from your end so that you can be able to follow up. So here we are discussing about August 2023. We have question number 2, part 2. Correct. So here I just be able to copy my months. Correct. Those are your months. We have the total working capital. The total working capital is there with you, correct? Then we have, what else do we have? We have the total working capital. So allow me just to be in a position to know, right? What is the permanent working capital of this organization? And I can see down there, right? There is an area. Are you given the permanent working capital? We are being told that the monthly working capital is all that, and we are being told that the short-term cost of financing, or cost of financing working capital, is 15% per annum, whereas the long-term financing cost is 20% per annum. And we are being told the company or the firms adopts an aggressive policy in financing in working capital needs. 80% of the firm's permanent working capital are financed using the short-term funds, and the balance is financed using the long-term financing. So you just need to be getting your permanent working capital here. The permanent working capital, and also we need to know the seasonal working capital, right? The seasonal working capital. So the biggest question will be, where is our permanent working capital? Just 1 minute, please. So I was just looking on we just want to look on how do we normally get our permanent working capital? That is the biggest question here. And when you are calculating your permanent working capital, it is very simple. Why? Because your permanent working capital should be the minimum level of the current assets. It's normally called the minimum level of current assets, right? So in this case, you just need to be copying your months. So we have January, we go to Feb, we have March, we have April, we have May, June, July, right? June, July, August. We have September, October, November. Then we have December. Correct. Now in this case, let us copy our data here. We are being given the total working capital. So in shillings, thousands of shillings. So in this case, the first one is 3,000. Here is 2,500. For March, we have 2,000. We have 1,500, right? Then we have 1,500. We have 1,700, correct? Then we have 1,800. We also have 2,800. Here we have 3,200. Then the next we have 35, 36. Two corners at 600. Then the last one we have 3,800. Correct. Now we have said that if we want to determine what is my permanent working capital, you will be able to know that it normally refers to the minimum level of current assets that a business required to maintain its ongoing operations. In simpler terms, to get your permanent, because you are just going to be copying it, you just look on your total working capital, which is your minimum value, right? And you'll be able to find your minimum value is 1,500. So in this case, you just come here, you place 1,500 across. So it will be 1,500, 1,500 there, 1,500, 1,500, 1,500. We have 1,500, 1,500, 1,500, 1,500, 1,500 all through, right? It means that once you identify your permanent working capital, it is very easy for me to determine my seasonal working capital. How am I going to be getting it? By taking the total working capital minus the permanent working capital. So it means 3,000 minus 1,500. You get here 1,500. The other one will be 1,000. Here we have 500. Here we have 0. Here we have 0 there, right? Here we have 200. The other one we have 18 minus 15, 300. correct? 2,800 minus 15, I think around 1,300. Then we have 32 minus 15. That toy is closer to 17. Then we have 35. This is 2,000. Here we have 21. Then the last one is around 2,300. So in another case, it is very simple. You just need to take your summation for permanent, and also for the summation for the seasonal. So in that case, I just take out my calculator, right? Just take out your calculator and I say, because these are the same, you just need to take 1,500 times 12. Because I think they are 12, right? So here totals to 18,000. It totals to 18,000. What about my seasonal? And in this case, I just say 1,500 plus 1,000. Let me just put 1,500. I just combine the two. Plus 1,800. Plus 1,800. Plus 17, that is 3,700. Plus, that is around 4,400. Are you getting like me? I'm getting 12,900. 12,900 is the answer here. 12,900. That is how simple the question was. So in this case, we just want to get the total costs. The total cost if they adopt the total cost if they are able to adopt aggressive strategy. What will be the total cost if they will be able to adopt the aggressive? And in this case, we'll say for permanent, how much will be for permanent? As per the information provided there, we are being told very well there that the short-term cost financing, right? We are being told down there, the financing working capital is 15% per annum, while the long-term financing cost is 20%. So in this case, it means, right? We just need to take 18,000. It should be 18,000, right? It will be 18,000 here times 18,000. The farmer adopted an aggressive policy in financing in working capital needs. 80% of the farm's permanent working capital are financed using the short term. So how much is our short term? Right? How much is our short term there? Someone to switch off the video, please. So the long term is 20%. Multiply it by the 20% we are being given up there. Then we are being told that we are adopting the farmer adopts an aggressive policy in financing working capital. 80% of the permanent working capital are financed using the short-term funds. So the permanent, what is the proportion remaining for the long-term funds? It will be 20%. So how much is that? Then we need to come to the seasonal. When it comes to the seasonal, it will be 12,900, right? Plus, we have the portion of the long-term funds, which is used to finance the short-term. So it will be 18,000 times 80%. Then after you do so, we need to multiply, because we have been told the short-term cost or the short-term cost of financing working capital is 15%. You multiply here with 15%. I don't know whether you are able to get. So what is the answer for the two? I said, you take the 18,000, which is your permanent working capital, you multiply by the 20%, we are being told is the long-term financing costs per annum. Then when you go to the aggressive policy, which we adopted, you'll be able to find the 80% of the farm permanent working capital, they will be able to be financed using the short-term funds. But now the permanent, you know very well, we are using the permanent, not the fluctuating, we use the long term. What is the proportion remaining? So it is 100% minus 80% getting the 20% is the difference. But when it comes to the seasonal, because the seasonal is used to finance the short term, that is what we want to know. What is the proportion which is coming from the permanent working capital used to finance the short term finance? So how much is this? how much is this? How much is this? Very simple. I just say 18,000 times 0.2 times 0.2. I'm getting 720 plus, right? 18,000 times 0.8. How much am I getting there? 14,400 plus 12,900 times 0.15. 0.15. I'm getting 4095. So how much is the total in Kenya shillings? How much is the total? Plus 720. I'm getting 15,000. 15,000. That is what you are required to do by the examiner, by the way. And you are supposed to be getting yourself how many marks? Examiner was giving you 6 marks. Determine the total cost of financing the working capital needs of the firm. That is what you are required to do. Any question? Any questions so far? Any question?
Yes, Malimo.
Yes.
While calculating the seasonal one, the 12,900, I saw you. Why do you add 18,000?
Because in the statement, very well, it tells us 80%, we have been told there clearly that the firms will be able to adopt an aggressive policy in financing its working capital need. But we have been told 80%, which is this one, of the permanent working capital are financed using the short-term funds. So we are using the seasonal. That is why we want to know that proportion, which is used to finance, that proportion of the permanent used to finance the seasonal. That is why we have taken 80% of the permanent, 80% of 18,000. Are we together?
Yes.
Abraham?
I got it, yes.
Okay. Now, I just want to get back because that is the requirement. These questions nowadays are coming in an exam, so it is very good for you to know how to handle them very handy. I will just be able to send another one, by the way, in our WhatsApp group from a different platform so that you can use it for practice. And in case you need the answer for it, I will be able to share. Allow me to look on the factors that influence the firm's investment in the working capital. Number one, we are looking on the nature and size of the business. And we are saying a manufacturing firm will have a bigger percentage of its investment in non-current assets when compared with the current assets, while the service industry, such as the financial institutions' working capital, so current assets will be more. Let us look on the manufacturing cycle. The longer the manufacturing cycle, the longer the firm's investment in working capital. That is, a company will require more current assets if its cash conversion cycle is low. Another one, we can talk about the production policy. If a company adopts a consistent or stable production policy, more inventory will accumulate during the off-peak seasons. Right? We have the availability of credit. A firm that can access some financing easily shall always have a lower level of working capital than a firm without such a facility. The other one, we have the growth and expansion activities. We are saying the working capital needs of the firm will always increase as the firm grows in terms of the revenue and the fixed assets. Now, we have the operating efficiency, and we are saying the working capital needs of the firm will always reduce at the price of the cash conversion cycle. Right, the cash conversion cycle accelerated with an improvement in the operating efficiency. Those are some of the factors which an examiner can be able to test you, and it is very good for you to just go through them in your notes. So that is not something that should be giving you an headache. So you just need to master those factors. Now, it is very important for us to look on something called the management of receivables, right? I know very well that some of us might be working as accounts receivables. Now we know what all of these means, right? We normally have payables, right? And then we have the receivables. These are the people who are interacting with our customers, and they assist us to get the funds. They assist us to get some funds. So in that regard, it is very crucial for us to be in a position to understand what the receivables and payables are all about. All of these shall be discussed in different topics, when you are going to be looking on the cash operating cycle, among others. Now, the management of receivables, we are saying, receivables constitute a significant portion of the firm's total investments, and its management is carefully planned. Just like any other working capital component, the objection of receivable management is to reflect the two conflicting objectives. The investment in receivables is influenced by the firm's annual credit sales and the receivables period. E.g., if the total sales of a company are 400 million, right? Let me just look at it in that manner. If the total sales of a company are 400 million shillings per annum, 60% of which is on accredited terms, and on average, customers pay after 30 days. In a year of 360 days, the firm's investment in receivables can be determined as follows, right? That is why here, I just want to be able to give, because I have said the investments in receivables influenced by the terms terms of annual credit sales and the receivables period. Let us look on what does this mean. Let me say this, right? Let me say this. If the total sales of a company, if the total sales of a company is Kenya shillings 400 million, if the total sales of a company is 400 million per annum, right? Per annum, 60%, which is on credit, of which 60% of which is on credit terms, 60% which is on credit terms, and on average customers pay after 30 days. After 30 days, they normally pay after 30 days. Your customers will be able to pay in that days, and we assume a year of 360 days, right? 360 days. The firm's investments in receivables, can be determined as follows. These formulas, we'll be able to write them very much as we can. So to get our receivables periods, to get your receivables periods, we are going to be taking the number of days in a year, 360. We multiply by the average receivables. Right, average receivables. Then you divide it by the annual credit sales. The annual credit sales. And because we just want to get the average receivables, we just want to make the average receivables, I'll just be able to say, make average receivable the subject. Make the average receivables the subject. Correct? So in this case, it means I just need to cross multiply, and I'm going to be having 360 times average receivables, which you are going to be having the receivables period. The receivables period times the annual credit sales. Divide here by 360, which you are assuming it is the number of days in a year. So in this case, it means to get your average receivable, we'll be able to take the receivables period. Be able to take the receivables period times the annual credit sales. The annual credit sales, you divide by 360 days. 360 days, right? So when I look on the illustration which I was able to place up there, we have said if the total sales of the company is 400 million shillings, right, per annum, 60% of which is on credit terms and average customers pay after 30 days. And we assume 360 days in a year, right? How can we be able to determine the average receivables? It is very easy. How? Because to get the receivables period, it means the receivables period will be able to take what? Because we need to get what? Very simple here. We are being told that 60% of which is on the credit terms. So what is the annual credit sales? That is what I was looking at. Because the receivables period is given there, which is 30 days, times the annual credit sales. You remember we are being told 60% are on credits. So it will be 60% of our sales times 400 million. Then you divide by 360 days. You divide by 360 days. In that case, you will be in a position to determine how much is your average receivables. How much is our average receivables? Very simple. 0.6 times 400 million. Right? Times 30 divided by 360. The average receivables of these organizations should be 20 million. The average receivables of these should be 20 million. Should be 20 million. Should be 20 million. That is how you normally get those kinds of questions. That is how you can be able to sort it out. Now, in that case, allow me just to move on, because I just want to do 2 more illustrations before we stop. So allow just me to continue elaborating my notes so that you keep on understanding as more as we move on. So when you look on our notes here, the ones which I'm just moving on with, we are saying the management can be able to influence the firm's level of credit sales, the receivables period, and conceptually the average receivables through a change in the credit policy. So the term credit policy refers to the contribution of 3 decision variables. We normally have the credit standards, we have the credit terms, and then we have the collection efforts. What does the credit standards mean? It refers to the procedures put in place to help when deciding on the types of the customers to whom credit should be offered. And that is why I said you cannot be able to give everyone the credit. No, you cannot. So that is where we have to be looking on the eligibility of customers based on how they are supposed to be paying. Can they be able to pay us, among other considerations? Now, we are saying very well here. Someone to switch off the video, please. So when the standards are too strict, the credit customer should... Oh, that person does not hear me. Who is Mary? Who else? Thank you. So I was saying that when the standards are too strict, the credit terms, the credit customers would be less, receivables would be less, and even the bad debt losses would be less. When the standards are so lenient, credit sales would be high, receivables would be more, and bad debt losses will also be more. That is why we need to put some strict measures within the organization so that the clients are in a position to understand the requirements of the organization. And we are saying that when the standard are so lenient, that one we have already factored. Let us look, what is a credit term? And it refers to the credit period offered to the customers and the cash discount offered, if any. And we are saying, e.g., the credit terms of 2/12 net of 30 days means that the customer who pays within 12 days are offered 2% discount, while other customers should pay within 30 days, right? So you see that there are terms in which the organization tries to put in place that if, for example, and these are the credit terms which are agreeable by our clients. So if the clients are able to do a 2/12 net of 30, it means that the customers who are going to be paid within that 12 days, they are going to be given a 2% discount on the selling price, right? While the customers, the others should be able to pay within the 30-day period. Now, that is the receivables period. What about the collection? And I know that we are dealing with the some account receivables here. Sometimes in other organizations, we call them credit controllers. And it refers to the procedure to be followed when dealing with overdue accounts. That is, account which may be outstanding after the receivable period lapses. What are some of the measures which we normally put in place? I know very well that the procedures normally we have to be putting up the phone calls. Someone is greeting me. Mary can't see the notes. Is it the case to the others? Can we see the notes?
Oh, I can see the board. Yes, right. It's clear on my side.
Right. What about the others? Are you facing the same problem as Mary? Paul, can you be able to see?
I can see, sir.
Thank you so much. So now these are the things which I was able to say that when you are dealing with some stubborn, you normally call them stubborn customers. These are the people who they don't want to pay you easily. They just want to mess up with your cash flow arrangements which you have within the organization. So in that regard, we are saying here, these procedures, sometimes we normally start by factoring the phone calls. We do reminder letters, right? Thank you, Rama. We do reminder letters, interest on overdue accounts, factoring, and as a last resort, we normally do legal suits. These are the procedures we normally follow up when we are dealing with these stubborn customers. Very well, we know very well that sometimes we normally start with the phone calls, no response. We do the demand letters, right? We do the interest on the overdue accounts. Sometimes we can do, the last resort we can do is involving the debt collectors. We'll be assisting you to do collection for your overdue debts. Now, factoring on receivables, right? And before I go there, by the way, before I look on the factory receivables, it is very important for me to do 2 quick questions, which are coming from this area of concern. And I will be able to do some questions, sometimes a long time ago tested, right? Let me just do some question tested on, let me start with November 2015, so that you will be having a good understanding. Let's do 2015 there. We see what we have. Okay. Okay, let me start with November now. And you're looking November 2015 financial management. It should be question number 2, right? It should be question number 2C. Who is reading for us right now? Someone, please. Question 2C very quickly.
I'll read it.
Okay.
Cindy Limited currently gives credit terms of net 30 days. The company's average annual sales amount to 120 million. The average collection period is 45 days. The management intends to increase the credit period to net 60 days. This plan is expected to increase sales by 15%. After the change in credit terms, the average collection period is expected to be 75 days. Variable costs are 80% of sales. The company's required rate of return on receivables is 20%. Corporate tax rate is 30%. Assume that 360 days year required. Advise the management of Cindy Limited on whether to relax its credit terms. 6 marks.
Thank you so much. The question is being brought looking like this. We are being told that the Cindy Limited currently gives credit terms of net of 30. The company's average annual sales amount to 120 million, right? The average collection period is 45 days. Then we are being told the management intends to increase the credit period to 60 days. This plan is expected to increase the sales by 15%. But after the change in the credit terms, the average collection period is expected to be 75 days. What about the variable cost? We are being told the variable cost of ours will be 80% of the sales. So the company's required rate of return on receivables will be 20%. Very simple. So how am I going to be handling this kind of a question? So when you have this problem, just do this, right? So let us come here and analyze the current policy. Current policy. Then let us have the proposed. Let us have our proposed policy. Then here we have to be looking on the differences, whether we are getting a benefit or is a cost to the organization. Correct? So let me start by analyzing our sales. So how much is our sales? Very good. As per the question here, we are being told very well, how much is our sales? We are being told, let me reduce this to thousands of shillings. Right? So what is our current sales? The current sales under the current policy, we are being given 120,000. Right? But we are being told very well, the average collection period is 45 days. The management intends to increase the credit period to 60. This plan is expected to increase the sales by 15%. So how much is the proposed sales? 115% or 120,000? 115% now. 115% of 120 is how much? How much is that? Let me take my calculator. So 115, that is 1.15 times 120,000, getting around 138. Correct. What is the difference between the two? Is it a cost or a benefit? It should be a benefit because the difference of 18,000 should be a benefit to the organization if things goes well. Right? It means we are going to be increasing our sales by 18 million, sorry. Now, let us less our variable costs. Let us less variable. Let us less our variable cost, which you have been told it is 80% of our sales. 80% of the sales is how much? So it will be 0.8 times 120,000. Here we get 96,000. Right? Then we have 0.8 times 138,000. Getting 110 here. 400. Right? There is an increment, by the way, in the total costs. And in this case, remember how much is our cost increasing from 96,000 minus 11, 110, 400, getting a cost of 14,400. Right? So how much is our contribution? How much is our contribution? How much is our contribution? The first one will be 120,000 minus 96,000, getting 24,000, and you lock it here. Like that. Then you go to 138,000 minus 110,400, getting 27,600. What is the difference? Right? There is an improvement. There is a benefit here in terms of the contribution of around that 600. That's 600 there. Then we talk about, can we be able to raise our corporate tax? Corporate tax at the rate of 30%. We can just be able to work with that figure, 0.3 times that 600, getting 1080. Right? We get our 1080 there. Then let us get after tax cash flows. We'll be able to get after tax cash flows, yes. That's 600 minus 1080, getting 2520. 2520, correct. But now we just need to be calculating our opportunity cost. Right? Why am I calculating the opportunity cost? We have been told very well there will be some changes in the terms. So in this case, it is very simple. By determining what is an opportunity cost, we are calling it the average receivable, right? You remember how we were calculating our average receivable? We said, can I be able to take what? Can I be able to take the receivables periods? Receivables periods multiplied by the annual credits, credit sales, we divide by 360. So in this case, the receivables period of ours is how much? How much is our receivables period? Right? So the current policy, let me start with the current policy here. In our current policy, the receivable period of ours is 45 days. We multiply by the annual credit sales. Do we have them? We are being told the company's average annual sales amount to 120 million, right? We are not being told whether we have the cash. So let us assume the full of 120,000 is on credit. Then we divide it by 360. We divide it by 360. So 45 times 120,000, right? We divide it by 360. We are getting the first one. The current policy, the average receivables of ours is 15,000, correct? Now, what about for the proposed policy? For the proposed policy, we are being told very well that after the change in credit terms, the average collection period or receivables period, they will shift to 75 days. We multiply by the annual credit sales under the proposed is 138,000. We divide it by 360. How much it is? So 75 times 138,000 divided by 360, getting 28,750. 28,750. And when you look at it here, under the, we are being told very well that the company's required rate of return on these receivables will be 20%. So in this case, to calculate your opportunity cost, it will be, you look on the average receivables under the current policy, you find it is 15,000, right? Minus the proposed policy, the average receivables of them is 28,750. Then you multiply this by 20%. What you are going to be getting here should be your opportunity cost. What you're supposed to be getting here should be your opportunity cost. You have taken the current policy of 15 minus the 28,750 times 20%. How much is the answer? So this is very simple. I just say 15,000 minus 28,750 times 0.2. I'm getting 2750 negative. 2750. Right? What is our answer there? What is our answer? The net cost of ours is how much? What we are getting is net cost. So 2520 minus 2750. You are getting 230. 230. So when the examiner is asking you to advise, you are being told to advise there, right? To advise. So when we are advising, we are being advise the management of Cindy Limited on whether to relax. And you can be able to say, when the current asset increases, right? So that you can be understanding. Let me just put it here. When the current assets increases, right? When they increase, opportunity cost increases. Opportunity cost also increases. Opportunity cost increase while current liabilities increases, right? Increases, right? While when the opportunity, when the current liability, sorry, while when the current liabilities, increases, right? Opportunity costs will reduce. The opportunity cost reduces and vice versa. Therefore, the advice that you're supposed to be giving this organization is the advice now. Because you can see you are getting the net cost, not a benefit. We say the management should not relax the credit terms. Should not relax the credit terms. Should not relax the credit terms. We have said the management should not, because you are not getting any profit at the end of the day. The organization is going to be suffering due to the new policies in which you want to make. And therefore, the management should not be able to buy the new ideas of extending the credit terms, of exceeding or prolonging the credit terms within the organization. Now, I just want to look on a different set of a question so that we can be in a position to understand how these questions are basically set. Unless there is someone with a question. If you have a question, you can ask. Just want to look on a different way on how these questions are basically set for your better understanding. Any questions so far? So if we don't have any question, is it possible for me to do September 2015 question 4B? Let me look on September 2015. September 2015, we have question 4B. Question 4B. Who is reading for us now? Right. Shafana Limited. Okay. Someone to read? Taylor, you can read for us.
Shafana Limited currently operates with terms of net 72 days. The firm's average investment in accounts receivable is 2.4 million shillings per year. 80% of the firm's sales are always on credit. the company is considering introducing terms of 220 net 90 days. 2/20, sorry. The firm's total sales per annum will increase by 50%. All cash customers and 40% of credit customers will take advantage of the cash discount. Average collection period will increase to 80 days. Gross margin on sales is 40%, while the cost of capital is 16%. Required, advise the company on whether to switch the new credit policy.
So it means this question is already drafted differently from what we have learned so far. And you can see here we are discussing about being given some gross margins on sales. So first I have to be determining how much is my sales at the end of the day regarding to the information provided up there. So in this case, it is very possible to determine that the average receivables, the average receivable provided here, we are being given is 2.4 million because we have been told the firm's average investment in account receivable is 2.4 million per year. 80% of the farm sales are always on credit. Already they have stated up there. And we are being told the company is considering introducing terms of 220 net 90 days, right? So in this case, we are being told the firm's total sales per annum will increase by 50%. All cash customers and 40% of credit customers will take advantage of the cash discount. We are being told the average collection period will increase to 8 days. Gross margin is 40, while the cost is 16%. So in this case, we just have the same format. We just go to the board. We just have the same format like the one that we had. This will be our format here. So we are going to be having the current policy. We'll be having the current policy, the proposed, and then we have to check on whether we're dealing with the period September. Okay, we're dealing with September here. So in this case, we're just going to be having the same cases. But in this question, we have to think outside the box. Why? Because the examiner has not provided you with most of the requirements as you require. So in this case, it means if I'm going to see or to check on my formula, which we said the average receivables of mine will be, we are going to be discussing about the collection periods, right? We're going to be discussing about the annual credit receivables period, receivables periods. We multiply by the annual credit sales. We divide it by, right? We divide by 360. They're using 60 or 65. Let me see. They are using around 360 days. Let me see. Yes. Let's just use 60 because that is what we have as per now. They have not given us the days. So in that case, just come here and you tell me that the average receivables provided by the examiner, because we want first to determine the annual credit sales. How much is our annual credit sale? And I would say, because the average receivables given is 2.4 million, we should be equal to the receivables period of ours is how much, right? Based on that information provided in the question, we are being told the current the Shavana Limited currently operates with terms of net of 72. So it will be 72. You multiply by the average credit sales, you divide by 360. Once you cross multiply here, you're going to be having 2.4 million times 360. You divide it by 72 so that you can be able to get the average credit sales. So how much is our average credit sales there? How much is our average credit sales? So just take your calculator. So it will be 2.4 million times 360. We divide it by 72. Getting 12 million. 12 million. So it means we have not gotten our total sales. So in this case, you tell me, because the examiner has told you 80% of the customers are always on credits, and the credit, the average credit sale, the annual credit sales, you know, it is 12 million. So you say, if 12 million is 80%, what about the 100%? You just need to cross multiply. And this one you're going to be having 12 million times 100 over 80. How much are we getting here? Right? So 12 million times 100 divided by 80. Here we are going to be getting our total sales is 15 million. Those are our total current sales. So our total current sales under the current policy, we have 15,000 here. Once you get the 15,000, let us look on the proposed policy. How much would be our sales? How much are we proposing? We are being told the firm's total sales per annum will increase by 50%. So it will be 1.5 times 15,000, right? 150% times 15,000, getting 22,500, right? What are the benefits accruing to the organization? We have 7,500 here. Correct. Now, because these are your sales, just ask yourself, do we need a lot of information in regard to this? And we say no. Why? Because I can just be able to get my gross profits or contribution, because to repair the gross margin. So our gross profits, we were given 40%, right? 40%. If I take 40% of our benefits here, how much am I going to be getting? 40% of our benefits, 0.4 times 7,500, we get 3,000. We get 3,000 there, 3,000, get 3,000. Those are the gross profit. But we have some cash discounts which we are supposed to be factoring in. We have some cash discounts now, right? Remember, we have been told very well that the firm's average investment in account receivable is 2.4, 80% are on credits, and the company is considering introducing terms of 220 net of 90, correct? So in this case, it means that anyone who is going to be paying, right? Anyone who is going to be paid within 20 days is going to be, within 90 days is going to be given 2% of those people will going to be given a discount of 20. Correct. So how much is this? How much is this? So how much is our discount? And that is under the new proposal, by the way. Don't come and you tell me it is under the current policy, because the company is considering introducing. So it is just always going to be affecting it is going to be affecting the it is a proposal, it is a proposed it is under the proposed policy. So it is not going to be affecting the current policy. So in that case, let us look on the cash customers. Right? Cash customers. And we have been told very well that just want to refer something so that we can be able to understand. Minutes. Right. Now, we just need to understand here, when we are being given 212 of something else, we remember we said the two, in this case, we are being given 220, and we said that it will be meaning that the customers who pays within 20 days are offered a discount of 2%, right? While others should be paying within 90 days. I have said that the customers who pay within 12 days will be given a discount of 2%, whereas the other customers should be paying within 90 days. That is how that statement means. So in that case now, let's look on how we are going to be computing our discount here, because we are being told that 80% of these customers are always on credit. So it means the 20% will be able to enjoy the discount. So it will be, right, the 2% which will be enjoyed, right? It means for the people who we call them the cash customers, they are the cash customers of ours, and 80% is on credit. You remember that is what we were able to argue here. 80% on credit. So it means 20% they normally pay on cash times the proposed sales of ours, which is 22,500. 22,500. How much it is? Right? 20%, these are the cash customers. Let me just write it here. These are cash customers, and we'll be enjoying a 2% discount when they pay within the stipulated period of 20 days. So it will be 0.2 times 22,500, right? Times 0.02, right? We are going to be getting 90. So here will be a cost of 90 shillings, correct? Then we also have the credit customers. The credit customers are how many? So in this case, we're being told down there, all the cash customers and 40% of the credit customers will take advantage of the cash discount. So it will be 2% of 40% of the credit customers, correct? Times the total credit customers of ours, 80% of 22,500. Here's the 80 coming from. 80% is the total, right? 80% of 22,500. We just want to know the value in 22,500, which is on credit. So it is 0.8 times 22,500. We get 18,000. Once you get 18,000, it means 40% of 18 is going to be paid on credit, and 40, these are the debtors. They are going to be enjoying the discount. So you just multiply by 0.4 times 0.02, getting 144. 144, and it will become the cost to the organization because we have to pay out. Now, it is very important for us to calculate our opportunity costs. Opportunity costs. Our opportunity cost, which will be the costs to the organization. This will be the costs. So in this case, how are we going to be getting our, we start with the current policy. So in that regard, I can see there we are being told that our opportunity cost will be how much. So you remember that our formulas will not be able to change. We look on the collection period currently at 72 days. So it will be, for the current policy, it will be 72 times the credit sale, the annual credit sales, which is 80% of 15,000. You know very well now where that is coming from. Then it divide by 360. So in this case, 0.8 times 15,000, right? Times 72, you divide by 360. This is 24 here. We don't have there. Then we need to be calculating for these proposed policies. The proposed policies in regard to what? In regard to the credit terms. So you can see there we are being told very well that let me just read for better understanding that this company is considering introducing terms of 2/20 days net 90. Correct. So in this case, it means the firm's total sales per annum will increase by 50%. Okay, but you're being told all the cash customers and 40% of the credit customers will take advantage of the discounts, the average collection period will increase to 80 days. Correct. Now, we are being told there, right? We are being told that the gross margin is 40, while the cost of capital is 16%. So how am I going to be looking on the proposed policy down here? So for proposed policies, we will factor our discounts. So let me start with the cash customers. Let me start with the cash customers. And in that case, we start the cash discount, sorry. Let me start with the cash discount, which is the same. So in this case, I will be able to say, right, 40% of the, it is under the 40% are credit customers. But what is our annual credit sales, right? How much is our credit sales? Annual credit sale, it will be 80% of 22.5. We multiply this by 40% of the customers who will be taking the advantage of the discounts, right? Times the period in which they are supposed to be paying is within 20 days, right? Then we divide this by, we divide it by 360 days. So how much is this? So it will be 0.8 times 22,500, you determine the credit sales. You multiply by 0.4, who will be taking the advantage of the discount. Then the period in which they are supposed to be enjoying that is when they pay within 20 days. You divide it by 360. Here we get 400. And let us go to the proposed. The proposed, no, the credit now. The credit discount, which will be, the credit discount will be how much? The credit discounts here will be E40, right? 40% will be enjoying. So it means the people who will be having no discount, that is the term which I'm not supposed to be using, by the way. The people who will be having no discount, if 40 have already enjoyed, it means 60%. 60% of how much? 60% of the credit, 80% of 22,500. We multiply by what? Right? Let me just read down there for better understanding. The average collection period will increase to 80 days, right? So far is how much? 20. So 80. So let me check. Let me check. Let me check. Let me check. Just 1 minute. Let me do my calculation. It should be 60% of 80% times 22,500 times, now it will be increasing to 80 days. We divide it by 360. Right? Once we multiply with 80%, you are going to be getting the credit sales, the annual credit sales, right? The 60% will be the remaining portion because 40% will be paying on the, will be enjoying the cash discounts. So 60% of that times 80 days because it's the new credit, the collection period. So it will be 0.6 times 0.8 times 22,500 times 80. Then we divide by 360, getting 2,400. Getting 2,400 there. Getting 2,400. So in this case, it is very simple because we are going to be looking on the summation of the opportunity cost. The opportunity cost here for the current policy, we have 2,400 minus the total value for the proposed is 2,800. Correct? 2,400 minus 2,800. Then we multiply by the cost of capital of viewers, which is 16% in this regard. Multiply by 16%. How much is this? So it will be very simple. We just say 2,400 minus 2,800 times 0.16, getting something closer to a cost of 64 shillings. So what is your net profit? Because I know very well that we are getting the net profit. How much is your net profit? I say 3,000 minus 90 minus 144 minus 64. I'm getting a net profit of 2702. 2702. 2702. And because already we were being told to advise the company, we say the company should switch to the new credit terms, right? The company should switch to new credit terms. The company should switch to new credit terms. The company should be able to switch because it's going to be getting a profit. It should be able to get some profits there. Any question? I hope you can be able to get the video back and just go and do your revisions. Just do your revisions now because the work has just started. The work has just started. And that is why I've started by factoring the some of the topics which they might be disturbing you during the exam periods. So it is very crucial for me to factor them. And one of the key topics which I've seen, which is not missing in these exams, it is the working capital management. And then we shall be able to revert back to the other topics. For example, like I will be able to go to the basics, teach you basics of financial management for better understanding about discounting and compounding, which will be helping us to get a know-how of different topics. It is not units. They should be topics. Yes. Now, I will request us to stop at that point. I know that we have covered a lot in day one, which should not be the case to anyone. But we shall just be as serious as I am today, so that I just want to complete these computations because we are going to be doing a lot of questions. I just want, when you look on that past paper, as a student, you just smile because you are seeing familiar questions. You are seeing familiar questions which you can attempt. So it is my duty to ensure you understand and also you can be able to relate with what we are learning. Allow me to stop at that point. See you next time. When is our next time? You will be able to see on our timetable. You'll be able to determine when it is. Good night.
Thank you, Madam.
Good night, sir.
Bye.